Audit Department here at BDO, and thanks everyone for coming along tonight. The not-for-profit sector is a significant sector in this practice, and just from the presence here tonight, that's a demonstration of that. So we have a large client base in this sector, and it's actually a terrific sector to work in. I've got a number of the partners sit on boards of similar organisations, and we have a large client base in this sector. And the one guarantee is that there's a lot of change in this sector. And tonight's presentation by Clark and Michael will walk you through some of this. I'll just do a really quick introduction. Clark's IFRS, what we call an IFRS partner. He's part of the audit group, but he's also part of the national IFRS group. And he advises clients around complex accounting issues. And he certainly, part of his role is to keep myself and the fellow audit partners out of jail. So he certainly
so far so good.
So far so good. So he certainly gives us a lot of advice. But a lot of the issues he deals with are extremely complicated, and accounting standards are only getting more and more complex. And Michael is one of our lead partners in the not-for-profit sector. So, look, tonight really only works, and you'll only get value out of tonight if you're willing to ask questions, and they are prepared to take questions throughout the presentation. So, if they present on something and you're not quite sure, then there's really no such thing as a silly question. Please ask. I'm sure there's probably a few other people in the room who are thinking the same thing. So. Don't hesitate to ask. Again, I think there's some drinks on afterwards, so you're welcome to stay afterwards. And without further ado, I'll hand over to Clark. So thank you very much.
Thank you, Damien. If you've got any hard questions, please direct them to Mike. So, not-for-profit financial reporting update November 19. Just make sure this thing is working.
It is.
We're now on. That's good. Is that on? So we've got a big year ahead for not-for-profit entities. It's already been a bit of a big year because you've already had to apply WSB 9 this year for the first time, and going forward into the next reporting season, December 19, June 20. You've got 3 more significant accounting standards that we'll have to comply with. And they're the topics we're going to cover tonight. So we've got WSB 16 leases. I'm sure you've all heard of that standard. And it has a major impact on lessees, and that's what we're going to cover predominantly tonight. We'll comment on peppercorn leases briefly, because there was initially some real concerns about the accounting requirements on that. The WSB made a change late last year that has given some relief there, so we'll comment on that briefly. We'll then look at WSB 15 and WSB 1058, the standards dealing with income. They're quite significant and introduce some significant changes in the not-for-profit space, because the old WSB 1004, which we didn't really know how to apply for that whole case because it was very vague, has gone and has been replaced by those new standards. Predominantly what we're going to look at in that area is the whether you are accounting in accordance with WSB 15 or 1058. The issue is what standard are you under? That's the issue we're going to comment on tonight. We're not going to go into detail about the application of WSB 15 because that's a whole other story. So there is an issue about which one of those standards you get into, because you really only get to defer it and you recognise it over time if you get into WSB 15. If you're in WSB 1058, when you receive a grant, receive cash, if you're not, if you're in 15, with one exception, it's income straight away. If there's no other what's referred to as standards later amounts, we'll talk about that. So we're going to try and focus a little bit more on the practical issues tonight on the application of these standards. In the past, a number of you have been to these presentations before, we've talked at a bit more higher level, but we're going to drill down a little bit more into some of the practical application issues and the considerations that we should be giving on those matters that I've just mentioned. In terms of the effective dates of these standards I just mentioned. WSB 9, which you should have already implemented. On some entities, it may not have had much of an impact, whereas other entities, it has had significant impacts. I suspect that we still some ongoing issues with WSB 9 over the future years for various entities, because there are some difficulties in that standard on impairment and things like that, which I'm sure some of you have dealt with. The other standards, you can see the application dates there, December 19 for your December balance date, June 20 for your June balance date. Just in the last week, so that's how recent these slides were prepared. 21 November, the WSB meeting, they decided to defer the application of the new income standards by not-for-profit entities for research grants from 1 January 19 to 1 July 19. So that means if you're a December balance date entity, they've decided you don't have to apply the new requirements for research grants until June 2020. They haven't really explained why. The literature they've put out today doesn't really go into any great detail. So obviously there's something going on behind the background with research grants. We know from some exercises we've done that there is great difficulty in understanding what the real requirements are for research grants going forward. So under the new standards, so maybe some of the complexities have caused the WSB to reconsider some of their guidance. So we'll see a bit more about that in the coming days, I assume. We're going to start off with WSB 16 leases because that's the big one that's going to impact many entities, if not nearly all entities. So, and the big news on that one, as no doubt most of you are aware, is that for lessees, it's the end of the road for operating leases. We no longer, as a lessee, have to determine whether we have operating lease or a finance lease. We don't need to make that decision anymore. All leases, with a few exceptions, are on balance sheet as a lessee. You have a right of use asset and a lease liability. And there's lots of complicating issues within that, but just as a basic principle, we don't have any off-balance sheet operating leases anymore, apart from a couple of minor exceptions. So with that, the key changes, no more straight mining of rental income, or rental expense I should say. Expenses are now front-loaded, and I'll show you a simple example of that shortly. We have right of use asset and lease liability, whereas in the past we may have had nothing on the balance sheet for, say, a lease of a building. There is an issue about what payments are included in the right of use asset and lease liability calculations. It's not all payments that you might have under a lease agreement. The payments that are recorded in the accounting are fixed lease payments, index-related lease payments. They're variable payments that are index-related, such as a CPI or a market rental related payments. So other variable type payments, in many cases, are excluded from the accounting under the, as part of the right of use asset and lease liability calculations. They will be expensed as you go. Another new issue that the standard deals with that we really didn't have to deal with under the old WSB 117 is option periods. Because in the old days you get motor vehicle leases, standard lease for 5 years and that's it. Of course, with property leases, in many cases you have options for renewal of the lease period. So that standard or new standard deals with those options, and how do you take those into account? You can't just ignore them. In fact, you have to take them into account in the lease term where it's reasonably certain that you will exercise the option. And we'll look at that in a bit more detail as we go. What are some of the impacts of the changes of these changes? As I said earlier, there's a change in the expense profile. So we have the impact is that we have higher expenses in the early years of the lease and lower expenses in the later years of the lease. EBITDA changes. Now that's probably not so important in the not-for-profit space, maybe in some cases, But in the for-profit area, that is a significant impact. So EBITDA changes because the lease rental expense in the past was above the EBITDA line. Going forward, that's replaced by interest and depreciation or amortisation. That's below that line, so EBITDA increases. Obviously, balance sheet ratios will change. Gearing ratios will change with recognition of an asset and liabilities, and of course the liability is split between current and non-current. So you'll have impacts on balance sheet ratios, which leads to possible impacts on bank covenants. So some entities should be modelling what the impacts of this standard will be on them, and if they have some issues with compliance with covenants, talking to their financiers. There could be other flow-on effects to various contracts that have profit-related requirements or balance sheet-related requirements. There could be impacts on those as well as a result of this new standard. So it can have a wide impact. Just a very simple example just to illustrate that. So we're just assuming we've got a lease of an administration building, which in the past would have been an operating lease, and therefore off balance sheet. We're just assuming payments, as you can see there, per month, just increasing $1,000 a month each year for 3 years, with an incremental borrowing rate of 10%. Now, the incremental borrowing rate is mentioned because we have to calculate the present value of the lease payments. And the guidance and standard is you use the interest rate of the lease if you can determine it. But of course, for a building, that'll be highly unlikely you will be able to do that. So what the standard says, if you can't determine it, you use the lessee's incremental borrowing rate to discount the payments to present value. So
the slides will be available to you all later on after this, so you don't feel you have to copy everything down, just so you know.
Yes, they'll be emailed.
I still make my notes, it wakes me up.
Just by way of illustration, so you can see here the impact on the profit and loss. Under the old standard, you would have had a straight line expense of $72,000 in this scenario. Whereas under the new WSP 16, that operating lease expense has been replaced by interest and amortisation in the profit and loss below the EBITDA line. And you can see how much it will be in this simple scenario. So the amortisation expense, we're assuming straight line amortisation, which will be adopted in most cases, but it's the interest expense that declines over time. And that makes sense, of course, because the liability declines over time. The interest rate's the same, it's the liability that declines. And the interest rate you apply, of course, is the discount rate you use, 10% in this example. So you can see that there's an effect on the total expenses, they decline over time. So earlier on in the life of the lease, expenses are higher, in the later part of the life of the lease, expenses are lower. So it changes the expense profile. It doesn't look like a lot here, but if you think of an entity with many leases, it can be quite significant. Probably a bigger impact is the balance sheet impact. So under the old standard, being an operating lease, nothing on the balance sheet. There might be some straight lining accruals, I'm ignoring that. But effectively, there's no assets or liabilities to the operating lease. Whereas under the new standard, we don't have to determine as a lessee if we have operating leases and finance leases. Interestingly, lessors still have to assess that. But as lessee, we don't need to. So as lessee, we'll recognise the right-of-use asset, recognise a non-current lease liability and a current lease liability. I've had a couple of people ask me, can we split the asset up into current and non-current? Unfortunately not. So we will have a negative impact as a result of the standard on current ratio. You can see there that this example shows the impact, the net impact is a reduction in net assets. That typically will be the case. Typically the liabilities will be greater than the right-of-use asset throughout the life of the lease. Of course, at the end it comes back to zero. I won't say that will be the case always, but typically that will be the case. So negative impact on net assets. The impact on statement cash flows, obviously the total cash flows are going to change. But the line items of cash flows will change, and the operating cash flows in particular, the net operating cash flows will change. Because the rental expense in the past will form part of operating cash outflows, so affecting net cash flows from operations. Going forward, the cash flow will be a financing payment, so it'll be down to financing cash flows on an operating, so operating cash flows will be better. The other part of the payments will be an interest expense. Now that will depend, each entity has a choice of where the interest expense gets shown, or the interest payments get shown in the cash flow. So it could be up in operating or down in financing. That's an entity choice. So there's significant impacts on the statement cash flows as well. Now, I said that it's the end of the road for operating leases, all leases on balance sheet. There are a couple of exceptions, and they need to be mentioned. The first one there is low value items. Now, the standard doesn't actually put a monetary amount on that in the standard itself. It talks about it being for items like laptops and phones and things like that. The value you take into account in assessing whether something's low value is the value of the item when it was new, not the value, not the current second-hand value. So it's important to understand the value when new. So if you've got a car, for example, not many cars cost less than, say, $5,000. Not many cars will be low value. The $5,000 amount there comes from, that's actually mentioned in the basis for conclusions to the standard. So not in the standard itself, but it's buried up in the back of the literature. So if you convert that, what's that, $7,500 Australian? Something like that. Changes as the exchange rate changes, of course. I think the Queensland Audit Office have a guide of maybe $10,000, below $10,000 is considered, or Treasury, I'm not sure. Somewhere in the government sector I've seen $10,000 amount mentioned. If anyone here is aware of something different, please let me know. And so I think below $10,000 from their point of view will be considered low value. So when new. So what does that mean in practice? So most commercial photocopiers won't be low value. So that costs 20, 30 grand, isn't it? So they won't get within the low value exemption. There's also an anti-avoidance measure. So you can't take a car and split the lease up. I'm going to lease the engine, I'm going to lease the tyres, I'm going to lease the body, I'm going to lease the seats. You can't lease the individual components and then say claim low value. Because the anti-avoidance measures in the standard are such that you have to look at it all together.
But you can group assets together. So if you're buying 20 laptops and they're all less than $500 each, that lease of the 20 laptops will fit under the low value asset.
Agreed, yes. So that's the low value exemption. Then there's the short-term leases. So leases of less than 12 months is another exception. So you don't have to put leases that fall in those exceptions. You can, because it's a choice. You don't have to put them on balance sheet. You treat them as you would an operating lease in the past. That's a choice. So peppercorn leases is something that's particularly important for not-for-profit entities. So we thought we should mention that. Now when this standard first came out, and amendments are to other standards as well, and including the income standards, etc., there were some changes to requirements for peppercorn leases, because in the past, everyone just ignored peppercorn leases, effectively paid $1 a year. Typically the dollar would then be paid, or maybe $100 a year for lease of land or land and building. No one's ever bothered about accounting for peppercorn leases. But when these changes to this standard and the income standards were made, this became a real topical issue, because initially the changes required that the fair value of the right of use asset be recognised on the balance sheet under the Peppercorn lease. The lease liability be recognised, which might be a very minor amount because Peppercorn amount. And what do you do with the difference? Well, counting under the proposals or requirements, as they were in fact weren't just proposals, was to recognise the difference as income. So I've got a simple example there. 30-year lease of a building, $100 per annum. The fair value is somehow miraculously determined to be $360,000. I don't know how that's been assessed, but it is assessed as fair value because how do you determine the fair value for all these restrictions on the use of an asset? Because they've been only used for, the asset can only be used for certain purposes. So what's the impact of the restrictions on fair value? So anyway, in the example here, we've determined the fair value of $360,000, and I would say this has actually been taken from examples in the standards, so this example. And the net present value of the future payments is only $1,537. So all of a sudden, you're going to be debiting right of use asset, crediting lease liability, and a big credit income. Now, imagine that, you're going to have this big credit income, and then over the next 30 years, you're going to be amortising that right of use asset straight line to $12,000 a year, no income. So that was a big issue when this standard, combined with the new income standards came out. Late 2018, so about 12 months ago, the WSB issued an amending standard. That amendment gave a temporary option to not-for-profit entities not to apply that. So you don't have to use fair value, so you can use costs. So effectively, for Peppercorn leases at the moment, you don't have to do the accounting I've just outlined. Now,
How long's temporary?
when I last talked about this about 6 months ago, we didn't know. Temporary could have been a long time, but sometimes it is with some of these things. But I've been following what the WSB has been doing on this, and they seem to be moving towards an exposure draft, amending WSB 13 on this very topic of determining fair value in these sorts of circumstances for not-for-profit entities. Now, if that gets through and becomes part of the standard, this temporary option may no longer be temporary. I mean, there was a second leg to their argument about why it's temporary, but whether that becomes stays or not means it still stays until they get through the whole process. That is legislative review, I'm not sure. But we need to, this is a watch this space type matter. It may not be temporary for a long time. So we may be faced with the problem in this account. Just as a comment, my reading of the literature is that the way they're heading in determining fair value is that you won't take into account the restrictions, which would be a bit bizarre. So if the fair value of this asset, it's an amount which doesn't take into account restrictions on the use of that asset. That's how things seem to be. But that may not end up being the standard. It's still working its way through the system. So we'll see what happens.
At this stage, it's just a case of saying, if you take the option, if you have personal leases, take the option not to book them, record that obviously in your financial statements, keep an eye and watch on what's happening, and get ready to do the calculations because you may have to do it soon.
I'll ask a question. Who here won't take the option? Who here will put the fair value on the balance sheet of the Peppercorn lease? Anyone? No one's rushing to do that. I wonder why. There's cost besides anything else because someone's going to have to measure fair value. It's not just pluck out of the air. So that's just some high-level comments. We'll now move into some of the issues with adopting WSB 16. And the first thing is transition. So going from the old standard to the new standard. So what do you do in transition? There's choice. This standard gives us choice. we can adopt what's called a full retrospective approach, which means we go and calculate everything as if we've always applied the new standard. Go back into the past, change comparatives as if we've always applied the standard. Or what we're seeing most people we deal with adopt is the modified approach. That is, you don't change the comparatives. You just, if there's any adjustment at all, you open your retained earnings on 1 July 19 if you're June balance date earnings. So comparatives change, stay the same, and you make an adjustment on 1 July 19 if you're June balance date earning. Now there's two choices on the modified approach. There's a simple one and a more complex one. And most people we're dealing with today have chosen the simple one. I don't know why. The simple one we refer to there as modified approach number 1. And what that is the right, you set the right of use asset to equal the lease liability. So you calculate the lease liability, which is just simply the future payments under the lease as at 1 July, discounted at the incremental borrowing rate, because in most cases that's what we use, as at 1 July. That calculates your liability, you set your right of use asset to equal that, nice and simple. The standard doesn't actually say it, but if you've got, it does say that if you've got accruals, you adjust that against the right of use asset. What it doesn't go into say is what do you do with lease incentives, what do you do with straight lining entries for operating lease rentals in the past. We view those as being accrual type entries, so they will be adjusted against the right of use asset. So those things have to be removed because they arise from the old accounting under the old standard, given that that's gone as of 1 July. So those balances relating to that operating lease have to go, so they get adjusted against the right of use asset. You know, straight line accruals or lease incentive on that lease. So effectively, under the modified 1, there's no adjustment against open retained earnings. Nice and simple. Modified 2 is more, and most not-for-profit entities we deal with so far, and I've spoken about this, have adopted that. Modified 2 is more complex. The lease liability is the same as under modified 1. It's the right of use asset that's different. You go and calculate that as if you've always applied the standard. There are a couple of differences to the full retrospective approach for that. One is that there's more practical experience available in how you do it, and we'll get to that in a moment. And the other is that the discount rate you use is the incremental borrowing rate, assuming you can't determine the implicit rate, the incremental borrowing rate at the date of initial application, which is if you balance that 1 July 19. Whereas under the full retrospective approach, you've gone back and used the incremental borrowing rate at the date when the lease started. So that's a little bit simpler, because you may not know what that rate was about years ago when the lease started. Now those changes are for what were operating leases in the past. If you've got finance leases and you apply one of these modified approaches, the lease asset and lease liability are what they were under the old standard on 1 July, on the date of initial application. Another way of looking at it is in this slide. So full approach, the adjusting comparatives, cumulative effect is put against the opening retained earnings at the beginning of your comparative year. You have a third statement of financial position because of the retrospective changes, and there's not much in way of transitional relief in doing those calculations. Whereas on a modified approach, we don't change the comparatives. Adjustments put through at the beginning of this year. No third statement, 2 approaches. There is more transitional relief, which we'll get to in a moment. So that's the 3 approaches which you have to choose from. I would assume most of you will choose one of the modified approaches, and I assume being off the problem, most of you will probably choose the simplest approach. I'm all for the simple approach personally. Makes it a lot easier. There's a number of practical expedients in the standard, and this one is available for all approaches, and that is you don't have to go, as at the date of initial application, you don't have to open up all your contracts and assess under the new standard whether you've got a lease or not. Now, when I say that, is under this standard, it has its own definition of what is a lease and its own requirements for assessing what is a lease. We have to apply that going forward. And it's different to the old standard. Under this practical expedient on the date of initial application, 1 July 19, this practical expedient says we don't have to go and question those other agreements in the past we've assessed not to be a lease. We just accept that they're not. And anything said to lease under the old standards will continue to treat as a lease. We only apply the new definitions for any contracts we enter into after that date. So it makes life a bit easier. There's a number of other practical expedients in the standard. Now, these aren't available if you've got full retrospective approach, generally. They do what they do in where applicable, make life easier. So, an example is the initial direct costs. So if you're applying the full retrospective method in determining the right of use asset, part of the calculation of that is the initial direct costs for that asset or for that lease have to be capitalised into the right of use asset. This practical expedient says that for applying retrospective method number 2, which we had on the slide earlier, right of use asset as if it was applied standard, we don't have to go back and calculate the initial direct cost for that particular lease. Makes life a bit easier. Under the full retrospective method, in theory, you do have to go back and do that. Another practical expedient under the modified method is that for leases that end within 12 months of the date of initial application, you use the 12-month short-term lease exception. If you're applying the full method, you can't do that unless the total term of the lease is 12 months. So under that one, you might have a 3-year lease, but there's only 9 months to go at 1 July 19. So if you're applying the modified method, you can take that practical expedient and not treat it as a lease for the accounting purposes. So you just continue to expense the payment straight on.
Is that only if you don't have a reasonable expectation that you'll take up an option, or?
So that's where the lease term ends within 12 months. So if you've got an option period, that your assessment would have to be you're not going to exercise that option.
Okay, yeah.
And there's a number of other practical expedients that you can see. So they're the main two. There's another one dealing with onerous leases, but they're not common, so I won't go into that. So a way of demonstrating the availability of those practical expedients, which can be helpful in certain cases, is that under full method, only the very first one's available, whereas the others are available under the modified method. So it again shows that the modified method is easier, less expensive. I'm not aware of anyone today that's adopted the full retrospective method. Wonder why. Now, another way of looking at this is to look at the pros and cons of each method. And if there's anything wrong here on this slide, I take the blame because I put this together myself a couple of days ago. So, looking at the full method, what's the pros for the full method? I guess one is there's greater comparability because your comparative numbers in the first year, your numbers for the current year, first year and the comparative year, are prepared on the same basis. Whereas on the modified methods, they're not because you don't change the comparatives. So there's greater comparability under the full retrospective method. I'm not sure of any other pros. Lots of cons though. A lot more effort required. Cost because of a lot more effort. Is the data available? You know, if you've got leases that have been in existence for donkey's years, is the information still available to be able to apply the method? And there might be impacts on the covenants because, as I mentioned earlier, typically the lease liability is greater than the asset, so net assets go down. So there might be negative impacts from a covenant compliance perspective under that method. Modified method number 1, much simpler, less effort, a lot less effort, a lot less cost as a result. no change in net assets. So think about covenants. There's no change in net assets, much more likely, or much less likely to be a problem in terms of covenant compliance. Cons there are comparability in year one. It's not so comparable. Comparatives haven't changed. Doesn't worry a lot of people. Might worry some. The biggest negative about that modified number one approach, where the right of use asset equals the lease liability, the biggest issue with that is that it leads to higher post-transition expenses, therefore lower profits in the future. And that's because your right of use asset is a higher number than it would be under this method or this method. If the right of use asset's a higher number, there's more depreciation in the future after the transition to this standard. So higher depreciation, more expensive, it's lower profit. Now, that will tend to be more of an issue in the for-profit sector because they pay dividends, etc. Some of our not-for-profit clients we've dealt with look at them, and we explained that and said, well, that's a non-cash expense, so we're not worried about it. But some entities may worry about it because it does mean there's higher depreciation or amortization, therefore lower profit. Modified number two, the pros there are that compared to full retrospective use, you've got the practical experience which you can use to simplify it a bit. But it's still got quite a few of the cons, I would suggest. So you don't get comparability because you don't change comparatives. There's a lot more effort required than compared to this one, therefore cost. Is the data available? Now, it's less of an issue here than here, because here you didn't go to determine incremental borrowing rate way back when, whereas here you use the incremental borrowing rate of the data visual application, on July 19, for example. But still, some data may not be available, on the leases way back in the past. And because the right of use asset would be less than the lease liability, there could still be also impacts on clients, therefore something that could be an issue. So I think that gives you an overview of the pros and cons for each of the methods, which you have to assess which method you're going to apply for transitioning for your accounting for what we're operating as under the old standard to the new standard. And on day one, that's probably that's a big decision. Has anyone made their decision yet, or most of you still working on your transition efforts? Anyone want to make an observation?
Is that okay with thought about?
We've been doing with a number of not-for-profits, and particularly in lease management services, which we'll touch on briefly later on. And most of our clients there have chosen in the not-for-profit sector have chosen modified number one because it's the simplest, least costly. Okay, lease term is another important issue under this standard, and it's a big issue, determining the lease term. Now, the lease term is defined in the standard, and it tells us that it's the non-cancelable period for which a lessee is right to use an underlying asset, together with periods covered by an option to extend the lease, if lessee is reasonably certain, I heard those words earlier, reasonably certain to exercise the option, and periods covered by an option to terminate the lease if lessee is reasonably certain not to exercise an option to terminate. So option periods do form part of the lease term, and therefore it's a key judgment about option periods. And the standard tells us you take them into account if it's reasonably certain that you exercise the option to extend. Now, the standard doesn't just stop there, it actually goes on and gives us guidance about making that decision, forming that judgment about what's reasonably certain. It tells us that we have to take into account the facts and circumstances that create an economic incentive for lessees to exercise the option to extend. And then it gives us examples of factors to consider.
So you have to think about when you're preparing your financials and you have leases and you have these judgments, disclosing that information in the financial statements, if it's significant, it's going to create a material change in the calculations. So it's not just a case of doing this in the background and forgetting about it, it's also potentially going to be disclosed right up in the financials, people can actually see what's going on.
A very good point. And up in that top box there, I put the comments that this emphasises this is an important decision because the longer the lease term, the higher the right of use asset and the higher the lease liability. Now, I know that some people think, oh, we'll always assume we won't exercise options. You don't have a free rein just to do that because the stance is that you have to take into account, you have to include it if it's reasonably certain to exercise, and you have to base that on economic incentives. So if you've always been exercising options in the past, and all of a sudden you say, oh, no, I'm going to exercise them, that might be a bit inconsistent, so you might have a question for the auditor on that, I would have thought.
Question?
What if you've got the option to terminate early?
That was in the definition. That was the second one here, this one. So are you reasonably certain not to exercise that is the question that you have to ask yourself.
So if you have an option to terminate after 2 years, it's a lease contract for 5 years, right to terminate after 2, are you going to exercise or not exercise that option?
Yeah.
And you have to assess that at the time.
Yeah. And it's based on what are you reasonably certain to do. And again, it's back to in making that decision, you have to consider the economic incentives and the factors to consider something that's more in the standard, some of the key ones I'll put here, the terms and conditions for an option period compared to market rate. So are you always going to be able to continue to have a below market rental compared to what you expect the market to be in the option period? Or if you've got significant leasehold improvements, and at the end of the first period, is there expected to be still significant value in those leasehold improvements? That would be an economic incentive to exercise. I've spent $1 million on the fit out. I've got a 2-year initial period and 4 lots of 2. In the first couple of option periods, you'd have a pretty good economic incentive to stay and get the value out of that fit out. Otherwise, you'd be abandoning a fair bit of value. Costs of relocation. If it's the more expensive it is to relocate, the greater the economic incentive to exercise the option. The importance of the underlying asset to your operations. So for some retailers, for example, the site might be a fantastic retail site. So you've got an economic incentive to stay. So you take those factors into account. And as Mike said, it's a key judgment. So I've just got a simple example here, and I think the answer is obvious when you go through it, but it's just to emphasise. So we've got a lessee enters into a building lease, non-cancel period of 3 years, and a 3-year option. Rentals are set at market annually, so there's no economic incentive either way because of the rentals, they don't impact you either way, right throughout the lease. But the lessee installs leasehold improvements at a significant cost, and which have a useful life of at least 6 years. And the building's also in an ideal location for the operations of the inn. So in making its assessment, it would assess in this case, most likely, that it's reasonably certain to exercise the option because of the leasehold improvements, because they're expected to have significant economic benefit when the option becomes exercised. Also, the rentals will continue based on market, so they don't affect you either way. And the site's expected when you're initially entering the lease or commencement, it's expected to continue to be an ideal site for your operations. So you assess the lease term at 6 years. It's the sort of judgment we're going to have to go through. And as I said, very important judgment because the longer the lease term, the higher the right of use asset, the higher the lease liability. Okay, so that's the lease term. Another important issue is dealing with changes during the lease term. Because unlike the old lease standard, that was the 117, we have motor vehicles, we entered a motor vehicle lease, it's fixed for the duration in most cases. Whereas property leases, which are caught under this new standard, you can see, are quite different. Throughout that property lease, we have options, which we've just been through. You don't typically have those in motor vehicle leases. We have options, and we might have a series of options throughout the life of the lease. Typically, we'll have annual adjustments to the rental payments, CPI or market rent reviews. Again, motor vehicle leases, the old standard, that was irrelevant in both bulk cases. Payments were set at the beginning. Under these new standards, they change annually. So we've got to deal with those changes ongoing. So lease accounting is more complex, far more complex now than it was in the past, because of the requirements to deal with those changes. And there are other changes too. There could be modifications, could be changes in assessments or various other assessments. So the standard gives us requirements as to how we deal with those changes. I've put here what I see as the most common changes, and that's the market rent reviews and CPI adjustments. Now, with those changes, we don't try and estimate them up front. We don't estimate them on commencing the lease. We only make adjustments to those changes when the cash flows change. So on day one, we use the payments as they are known on day one for the calculation of the whole lease term. And then we make adjustments for market reviews and CPI adjustments when the cash flows change. When we make those adjustments, we change the lease liability because payments change, therefore there's a new liability amount. We adjust the right of use asset by the same number at the time the cash flows change. So you don't have to make estimates up front. Another important point is certain variable lease payments are not taken into account in assessing the lease liability and the right of use asset. They're only expense as they occur. And in particular, payments that are linked to the performance or use of the underlying asset. They're only taken into account and accounted for as they occur in the period they relate to. So the classic example there is turnover-based rent. So I pay $10,000 a month for the lease of the shop, and I pay 5% of my turnover. So in that case, $10,000 will be net present value, and taking into account the right of use asset and lease liability, whatever the lease term is. 5% won't be. It will be expensed as you go each month. So those certain types of variable payments are not taken into account in the accounting for lease asset lease liability. I've got a simple example there that just emphasises that. I won't run through that. You'll have these slides so you can see that. But this example shows property lease, the right of use asset, lease liability calculated simply on the basis of the known payments on day one, and the future changes in the CPI are only dealt with in the future when they occur. Now this slide just is a high-level summary of all the possible the requirements. I won't say all because someone will find me out and say, no, you haven't taken this into account. So I'll say many of the possible changes, I'll say. So again, you'll get the slide. So it deals with what the standard requires for different types of adjustments throughout the life of the lease. So comments on remeasurements and reassessments, change in index or rate, affecting the payments. It says we use the original discount rate, so you don't change the discount rate, you just change the payments, and no adjustment on P&L, it's just debit right against asset credit lease liability. Same for a change in estimate residual guarantee, but if you reassess the lease term, you debit right against asset, because as I said, lease term affects the payments, therefore you have a new right against asset lease liability number. You don't have any impact on profit and loss, but you use a new discount rate. You use the incremental borrowing rate at the time of the change of the reassessment. Don't ask me why. I don't know why the standard setters did that. I don't know what was in their mind. But that's what they decided. And there's some other types of changes that you might have to deal with that this comments on as well. Changes in the scope of the lease. So what is that? So I lease 2 floors of the building on day one, and might have a 10-year term, and halfway during the life of the lease, for some reason, I no longer need 2 floors, I only need 1 floor. So I negotiate with the landlord to take 1 floor out of the lease. That's a change in scope. There might be a change in scope that adds another floor to the lease as well. So this standard has various requirements, and this just summarises the different ways the standard goes with those different changes during the lease term. So that's that's changes. The big difference between the old LIC 117 and the LIC 16 is those requirements of how you do the changes. I've talked about the incremental borrowing rate a couple of times. We're required to use that, understand when we can't determine the interest rate because of the lease. So we might be able to determine the interest rate because of the lease for a motor vehicle lease, for example, but we won't be able to determine it for a property lease. You just can't get the data to do it. So there you end up using the incremental borrowing rate. You have to assess that. Now that's defined in the standard. It's the rate of interest that a lessee, so it's specific to each lessee, will have to pay to borrow over a similar term. So if you've got a 3-year lease, the term is 3 years. If you've got a lease term of 3 years, that's the term. If you've got a lease term of 10 years, that's the term. Interest rates for different terms typically are different. So a lessee won't just have one incremental borrowing rate. Incremental borrowing rate will change for each lease, or may change for each lease. So it's the rate of interest lease we have to pay a lease term with a similar security. The funds necessary to obtain an asset of similar value to the right of this asset in a similar environment. So the important takeaway there is that the incremental borrowing rate is specific to the lessee, takes into account the term, and also the security offered by the underlying right of this asset. So incremental borrowing rates are a key assessment. You take a bit of work, and you will not just have one incremental borrowing rate. You could have a series of incremental borrowing rates for different reasons. Another practical issue is what systems do you employ to deal with this? Have you all decided on what systems you're going to use for dealing with lease accounting? Sorry?
We've seen that in practice. Obviously, Excel's pretty popular, particularly if you have a few handful of leases. It makes a lot of sense. But take into account that what we were talking about before. If CPI changes, then the whole calculation needs to change. So you've got a 10-year lease with annual CPI changes. That could be up to 10 spreadsheets that you need to calculate to determine the value. So if it's 1 or 2 leases, it's not a big deal. But when you start adding extra leases on, you can 3, 5, 10, 20 leases, times that by 10, we're talking a number of spreadsheets, pretty easy to make mistakes, and also just in general mistakes in Excel spreadsheets, formula errors, copy, paste, drag, whatever it is. We've seen this in practice at the moment, so we're sort of going through calculations that the clients are giving to us, trying to understand, or are we happy that they're calculating the right information. So just things to take into account. That Excel's good, it's great, fantastic tool. Use it if you can, but just keep in mind that there's potential limitations for yourselves and how you're going to manage that process.
Yeah, I think that sums it up. That there's small number of leases, Excel's fine, but the greater the number, the greater the risk of error. And also the sheer volume. So another slide here we've got on accounting systems is this is just our views. There's nothing in the standard about this. Could have been a video, but so what we're saying there is, maybe if you've got 1 to 10 leases, Excel's fine because it's not going to be too much in the way of spreadsheets and that. Remember, if you're doing these with lots of changes, which these standards have, this standard has, particularly property leases, it becomes voluminous, the number of changes. So when you get to a certain size, whatever that size is, some sort of system is the best way to go. Now, there's quite a few organisations out there offering various systems to assist with this. Lease Eagle, for example. I know KPMG are doing something similar to what BDO does as well. So there are various firms that are offering solutions to lease accounting systems. As a guide, and it's only a rough guide, 1 to 10 leases we're saying, well, you might use Excel. And you're more likely to use Excel in reality. Once you get above 10, up to 700, whatever the number of hundreds is, you might use an outsourcing type solution. And then once you get to a certain size, and something more than 200, I think, you might go and buy some of the license like BDO has a BDO license. We have various clients sign up that they're very large, 7-Eleven, Department of Health Victoria, things like that. So they're bought the license, but that's very expensive. And won't be suitable for any of you, most of you will not be suitable for. We do offer a lease management service, and if you want to talk to us about that, please do so. Just give either myself or Julie Pagdu a call, or Michael a call, we're happy to talk about that. So there are a number of accounting solutions. I just suggest when you're on a certain size and number of leases, using Excel will become very messy and prone to error. Okay, so is there anyone got a question?
Yeah, could you go back to your incremental borrowing rate slide, please?
Oh, the calculation.
Yeah, just to obtain an asset of similar value, what do you think, what does that actually mean? Because you're actually trying to compare this with something else?
Well, an asset, well, yes, because an asset of, so if the right of use asset is $10,000, might be a different nature of it and the value of it, may be a different risk to, because that provides a security, of course.
So the easiest way to explain it is say, I'm going to lease this building, the whole building. If I was to go borrow the money to buy this building, what roughly? No, that's roughly sort of, you've got to start thinking about the
It's the
similar.
right of use asset.
Yeah.
So, if the value is 10,000, the interest rate may be different to a $10 million interest rate.
Well, I was thinking more about what you would compare it to get something of similar value.
That's exactly.
Well,
Fair
it's
value.
it's not you're not taking the underlying asset. All you've got is the right to use asset. So the right to use that asset for a period of time. If you have it for the whole economic life of it, it's a different asset.
But it's sort of the fair value of
the
the
right
asset.
of use.
So whatever the asset's worth,
That's the value, but you take into account the nature of it as well. That would affect it.
So type of security you would use for it.
Yes.
Yeah. So if you're leasing a building, then the security for the loan of a building, I guess, that's the sort of way you look for to
It
say.
might be different to a mortgage.
Yeah. So you've got to try and compare it as close as possible. It's not going to be exact, but you've got to try and find something similar for the amount of money you're looking to use. So the fair value is $1 million. So get a loan for $1 million with a similar type of security. What would I get as my interest? And that's sort of trying to compare apples
The
to
important
apples.
thing is that it's specific lessee as well. So NWA over here may have a totally different risk profile to FBZ, so the interest rate's going to be different.
So if you went to your financer and said, this is
Us.
this, this is what
What could I buy?
What could I?
Yeah.
I guess that,
Yeah.
that's
a source of
would that
information.
be an acceptable rate?
That would be, yes. And the question would be, how, have you said to them, what would I have to pay you in terms of interest rate for this asset and this value over this term? So, but a starting point might be, what if I wanted to borrow unsecured this amount for this period, what would I have to pay you unsecured? And then there'd be adjustments from there for the level of security, for example, the asset that's provided. Because secured loans, that's like interest rate less than an unsecured loan. So start with the unsecured rate and then work from there. But take into account the term. 3 years versus 10 years is the difference.
I'm just trying to picture what the conversation was about.
And also another factor is the profile of payments, because the interest rate for an amortising loan is different for a loan interest rate on a loan that you only pay the principal at the end. So because the lease is typically amortising loan,
Okay.
paying principal interest.
Go to your financier, talk to them about what would they borrow to you at under the certain terms and conditions that you're looking for. That's your starting point.
Okay, thank you.
Of those three options that you had at the beginning,
Is that the transition methods?
yeah,
Yeah. Yes.
in our last year's statements, if we've already assessed the application of this standard and we were going to use that last option, but we're now going to want to change it to that middle option, is that going to be an issue?
I would have thought so if you haven't implemented it yet. If you've only said this is what we're planning to do, well, the plans will change.
That disclosure was around what the expected impact is going to be.
Yeah.
So I expect it to be this based on this, and then things have changed since then. I've now done this, and when you apply it, you'll be saying things in your account as to what you've done, how you've done it, what you've chosen.
That shouldn't be an issue. Because you haven't adopted it yet.
No.
Any other questions? We'll move on to the income standard slides. So, just we'll go through the 1058 quickly, and then there's a couple of examples I want to run through. So, WC 1058, it's the new income standard, replaces WC 104. It deals with receipt of volunteer services and other transactions where the consideration required is significantly less, acquire an asset, is significantly less than the fair value principal in aid and not-for-profit achieve its objectives. So, just a few comments on volunteer services. If you can assess the fair value of volunteer services, well then you've got a county policy choice. If you're in the private sector, if you can't assess the fair value, well, you can't account for it. If you can assess the fair value of volunteer services in the NFP private sector, then you have a choice. Do you account for it or not? How many of you, if you can, are going to account for it? Make that choice.
No, good.
Because that means there's a lot more work for you. It may provide the information, but you have a choice. If you're in the government sector, and if you can assess the fair value reliably, or measure it reliably, and the services would have been purchased, if not donated, you have no choice. You've got to account for volunteer services. Okay, so that's a quick commentary on volunteer services, on the new requirements in that standard. In terms of other income issues under the standard, it has new requirements for transfers and typically transfers in the form of cash, to a not-for-profit to enable a not-for-profit to acquire or construct a recognisable non-financial asset that will be controlled by a not-for-profit entity. And this standard has new requirements for that. The old standards didn't specifically comment on that at all. If you have a transfer like that, and a classic example is a government donation to a school to build a building to be used for school purposes, a building built on school land, and the school will use it for the next 20 years as required to. That's the classic example I dealt with in the past. So if that's the case, then you've got to recognise income as you satisfy your obligation under the transfer. I've got an example on that in a moment. If you haven't got that type of transaction, then we'll look at the other counting for income after that example. So this is a simple example, cash grant for construction of recognisable asset, you get $2 million to build an asset. It'll be on your land, in this example school land, and if you don't comply with the terms of the grant, you've got to give the money back. And if you don't use it in accordance with the grant, you've got pro rata, you've got to pay back over time as well. If you use it for the purpose of the grant for the next 10 years, at the end of 10 years, you don't have any further obligation. So under this standard, the $2 million grant, you look at it and you say, well, it's to achieve the objectives of the school, it's within 1058, within the new standard, and it's to enable the school to construct a recognisable asset, a building. So we apply that standard. The accounting this standard requires is up front on day one we get the grant, debit cash and credit liability. Now, I would assume in the past, many of you in those circumstances would credit income day one under Dudley 104. So this is a change in requirements. And then what you do, as you satisfy the requirements of the grant, the requirements are to build a building. So as you build a building, you reduce income and recognise, you reduce your obligation and recognise income as you're building the building. So in this case, at the end of year one, you're 60% complete, so you reduce your liability by 1.2 million. Then in year two, you complete the building and you reduce your liability and take the balance as income. So that's a change from the old Dulce 104 for those types of grants. For other funds paid that are required to account for under Dulce 1058, the basic formula is we account for the asset received in accordance with the relevant accounting standard. Now, typically, the asset received is going to be cash, but it's not always. So we receive cash, debit cash. But the asset received could be property, plant, equipment, so debit property, plant, equipment. We can't do that in accordance with the relevant accounting standard. Typically, the asset received has to be accounted for at fair value. You ask yourself, is there any related amount? That's the formula under the standard. Is there any related amount? Now, we'll get to that in a moment. If there's no related amounts, the excess of whatever the related amount, the excess of the asset over the related amount is taken income straight away. If there's no related amount, it all goes to income. That's the basic formula in this standard. Now, just drilling into that a little bit more, the asset received, it could be cash, it could be a leased asset, property, plant, equipment, it could be an intangible. Typically, it could be cash or property, plant, equipment, but it could be some other form. Leases, well, we've dealt with our leases earlier. The asset received is typically recognised at fair value. Now, the other standards, Dulce 116, Dulce 138, and even Dulce 16, they're all amended to say that if assets are received, so the not-for-profit can achieve its objective, that will be recognised at fair value. Amended when the standard came out. So you reckon the exception to that is Peppercorn leases under the temporary option. The credit entry, debit asset, cash or property, equipment, etc. The credit entry, you have to ask yourself is if there's any, what the standard refers to as related amounts. So what's the other side, in other words? It could be a contribution by owners. It could be a lease liability, so I get a right of use asset, I've got a lease liability, I've got to pay that. It could be a financial instrument. I debit cash and I've got an obligation to pay cash. That's a financial liability. Or it could be a provision in some cases. Typically, the issue we're going to be dealing with though is whether you're under WSB 15, whether you're in the revenue standard. That's what we'll concentrate on from here. So you have to determine if there's any of these amounts. If you do, you credit those. If there's none, then it becomes income straight away under the standard. Apart from that, where it's to construct a recognisable non-financial asset, which I read through earlier. So that's a high-level overview of Dulce 1058. Now, if we just look at Dulce 15, contracts with customers. Now, I'm not going to drill into the detail of this standard. We've covered this in the past, and I'm happy to talk to anyone if they want to about this standard in a bit more detail. But it introduced a 5-step model. We identify whether there's a contract with the customer. We identify what the performance obligations, so what goods or services do we have to transfer to the customer. And there may be one or more in any one contract. We determine the transaction price, we allocate it. Then we recognise revenue for the performance obligation as it's satisfied, which can be a point in time or over time. I'm providing services over time, I can recognise revenue over time. So typically in a not-for-profit space, the issue is, are we caught under WSB 1058 and have to recognise income on day one, or can we get into WSB 15 and recognise revenue as the services are performed over time? That's typically going to be the question that we're going to be asking. And you have to get into WSB 15 to recognise revenue over time. If you can't get into it, it's on day one. Debit cash credit. So this slide shows the criteria that need to be considered in whether you can get into WSB15 from a not-for-profit's perspective. So, the first thing you ask, are the funds received for a purpose of acquiring and constructing a recognisable non-financial asset? If the answer is yes, then you apply what we dealt with a moment ago. If the answer is no, the next question you ask yourself is, is there a contract with an enforceable agreement obligations? If the answer is no, well, then you're in WSB 1058. Income straight away. If the answer is yes, then you ask yourself, do we have sufficiently specific performance obligations? Now, for a performance obligation to exist, there must be a transfer of goods or services to the customer. If the answer is no to that, we go back to 1058 and it comes straight away. If the answer is yes, we go to WSB 15 and then we apply that standard and recognise revenue as we satisfy the performance obligations. So that's the thinking, not for profits are going to have to go through.
So it's a really good summary decision tree to follow. It's a good summary decision tree to follow. Make sure you're in the right standard, because as Clark said, if you're in 1058, bang, it's revenue straight away. If you're 15, you can defer, but you need to understand which one you're ready to start. So this is a great mistake.
So these are the key decisions that not-for-profits are going to have to drill down into going under the new standards. So what's an enforceable contract or enforceable agreement? So the standard tells us that an agreement is enforceable when separate parties are able to enforce it through legal or equivalent means. Okay, so some examples. An enforceable agreement that the standard gives us. If there's a refund in cash or kind required, if the performance has not occurred. Performance required under that agreement has not occurred, you're going to give the money back. That makes it enforceable. Another one is the customer has a right to enforce the obligation or performance or claim damages. It's enforceable. Now, typically at law in Australia, contracts between two entities are enforceable, but you need to consider each circumstance, of course. But where goods and services involved, typically is an enforceability in a commercial arrangement. Another example, the customer has a right to take a financial interest in assets purchased or constructed with resources provided under the agreement. That sometimes happens in government grants. There's more guidance on that in Appendix F, but they're the typical things we see and look for in assessing enforceability. So that's the enforceable agreement question. Then you've got the question is, do we have sufficiently specific performance obligations? Now what the standard tells us is that a necessary condition for identifying a performance obligation or not-for-profit is that the promise to transfer goods or services is sufficiently specific to determine when the obligation is satisfied. I'm putting an emphasis on performance obligation, so you have to have a performance obligation. That means there must be a requirement for a transfer of goods or services to the customer or to third parties as directed by the customer. So there's got to be goods or services transferred. And you've got to be able to tell when that obligation is satisfied. If you can't tell when it's satisfied, you don't meet the sufficient specific requirement. So you're in 1058, income day one. So I'll comment on the performance obligation, what that is a transfer of goods or service to the customer. That's distinct. Another way of looking at that, and this is how we at BDO look at it, is that if you look at what the requirements are under the let's call it grant. If the only requirement is I'm giving you money to do certain internal activities, there's no transfer of goods or services to a customer, can't be a performance obligation. You're in 1058. If the grant just has visions or goals, we're giving you the money to achieve this goal, again, there's no required transfer of goods or services to customer. No performance obligation, you're in 1058. Income day one. If you can identify external outputs, transfer of goods or services to customers or third parties as directed by the customer. So typically the customer's the government, but you provide service to needy people, that still satisfies that. Then you can have sufficiently specific performance obligations. That's a way of thinking about this, meeting this test. What you should be doing now, what most not-for-profits should be doing, is going through their grants and similar agreements and assessing, are they enforceable? Do they meet this sufficient and specific criteria? Therefore, are we in WSB 15? If so, how do we account for it in WSB 15 over time? That's the question you should be thinking. Because if you're not in WSB 15, because you fail those tests, you're in WSB 58 and you have to account for it income from day one. That's quite different to the old standards. The whole thinking's changed. So a couple of examples now. We're getting towards the end. I've got a couple of examples which we'll run through just to emphasise how those new requirements apply. So we've got a $2 million cash donation or endowment, whatever you want to call it, given by anonymous to a university. It can be invested at the university's discretion. It's required to return. The university is required to return the real value to the alumnus if there's any breach. It's enforceable. The university is required to provide free student accommodation each year for one student for 1 year, for as long, and this is the important bit, for as long as the university continues to operate as a university. And subject to the value of the $2 million being reserved, the income can be used to do that, and anything excess can be used by the university. You think you'll be able to determine when your obligation is satisfied if you say the obligation is to provide accommodation? You're going to do it as long as A continues to operate as a university. It'll operate forever. You go through the requirements, and it doesn't. There's no contribution owners, there's no lease, there's no financial liability, no provisions. None of those apply. But you consider the promise. Now, we are going to provide accommodation, so that's providing a service to someone. But the key is that you can't identify when the obligation is fully satisfied, because it's going to go on forever, as long as you continue to operate as a university. So it cannot be sufficient, specific, as defined in the standard. So it's incumbent on this example. That example is taken straight out of the accounting standards. It's not big. It's not something I made up. Now this is a video. This is not straight out of the accounting standards. This is how we see things. So Mr. Rich Gray is up in a home experienced violence, donates $1 million to Crisis Charity. The charter of Crisis Charity says that its objective is to provide crisis counselling services to those in need. So we've got three scenarios here, different scenarios. Question are, because we're going to determine are we in WSB 15 or are we in WSB 1058? That's the question, big picture question. Two things we've got to assess. Do we have an enforceable agreement? And if so, do they contain sufficiently specific performance obligations? You've got to meet both. If you fail one, you're in 1058. So in real life, you only have to assess it. If you assess there's no enforceability, end of story, you don't have to go any further. So, scenario one. Do you think that's enforceable? I don't think so. It just says, give me your money to use in accordance with your charter. Probably not even sufficiently specific, is it? Because can you identify goods and services that are required, an output? Scenario two, any unspent or misused funds will be returned. That's enforceable. But it's to hire social workers to review the programs and advise management on improvements in the programs. Is that internal, or is that goods and services transferred to a customer? That's the question you have to ask yourself. Scenario three, the funds will be used to provide 80 hours of crisis counselling services per week for 3 years. Is there a service being provided to a customer there? Is it enforceable? Unspent money or misused money can be returned. Those are the questions. So, as we would see it, scenario one is not enforceable and it's not sufficiently specific because there's no outputs you can identify. The other two are enforceable because you have to give money, you have to refund money if it's not used properly. But this one is not sufficiently specific because the hiring of social workers is an internal activity because it's only to advise management internally. That's all it's for. It's not providing anything to the outside public. So there's no output. Whereas in scenario three, there is an output. Services provided 80 hours a week.
Question?
I was just going to ask if it didn't say 80 hours a week, we didn't specify that and just specified must.
Open office and provide your
counselling
services.
For 3 years, is that?
Yeah, a good question. The examples of the standard suggest that it doesn't need something more specific like that, but our understanding is that is not.
Okay.
But you do need to identify outputs.
Yep.
Otherwise, you're going to fail. And you're in 1058 and it's income on day one. And if the reality, and not-for-profit entities, to my knowledge, those who do have to provide service with that grant for enough years are not going to like that because they're going to be providing services for these years, they're expenses for the years, but all the income is booked on day one. So people are not going to like that mismatch. But that's the thinking you have to go through now under these new
But it
standards.
gives you an opportunity. Gives you an opportunity to start looking at this now. Not too late now, but maybe start looking at this in the future. And if you have contracts that are like that, add in those sufficiently specific performance obligations so you can defer the revenue.
Yeah,
If that's what you want to do,
And make sure it's enforceable.
make sure most of them are enforceable. But yes, that's right. Tick the 2 boxes and it should be good.
And just to finish off, I've got an example of joining fees here. If you came last time, you received the same example. And the reason I've got that there is because the key message is that upfront fees aren't necessarily income on day one. Under old standards, upfront fees, joining fees for a gym, joining fees for a club, school enrolment fees might have been income on day one under the old standards. Assuming you're in WSB 15, and I should start off with that because you're not 1058. Assuming you are in WSB 15, upfront fees, even if they're non-refundable, will not necessarily be income on day one. If you can't identify satisfaction of a performance obligation for that month, for those fees on day one, transfer of goods and services to customer at that point in time, you can't recognise revenue. There's no performance obligation satisfied. So they'll end up being accounted for over time. So in this example, the joining fees of the gym are accounted for over the expected life of membership of the person joining the gym. Because there's no transfer on day one. They don't get any benefit for anything on day one. That's how WSB 15 works. There are transition issues on WSB 15 as well. You full retrospective, or you apply a modified approach and only change the current year with comparative as they were. I won't go into detail on that. In the period of time. Any other questions?
I think it just reinforces document what you think you're doing, how you're doing it, which standard you're in, to make sure that you've got that information available. Some of those things are going to be easy, some of them are going to be a bit more complicated, but documenting that process that you're thinking is fantastic. Because that then will also require disclosure in financial statements, require reassessment going forward. Grants are going to change, your requirements are going to change. So if you document it once the first time, you do it right, then going forward, you just keep updating and changing. So hopefully you've got a bit of information there to go on with, and if you need some help and support, please let us know. Does anyone have any burning questions they want to ask?
Or other questions other than the questions?
I've got a question. What's the treatment if you have a license agreement between your organisation and another entity? Is it treated as a lease?
It will depend on the terms of the license. A license could be a lease because something doesn't have to say it's a lease. Determining whether there's a lease considers the underlying circumstances, facts and circumstances of the agreement. So certain licenses may be leases. Some licenses actually get accounted for under the revenue standard as well. Depends on what the license is for.
Thank you.
So there need to be an assessment of the terms and conditions of license, background, etc. Any other questions? Okay, thank you everyone. As Damien said up front, we have some drinks and such as that, I think, out in our foyer. So please come and join us, and if you've got any questions then, I'm happy to, thank you.
Thank you.
Thank you.